Hi, in this video, I will show you how you can value a firm using the free cash flow valuation method. Let's talk a little bit about free cash flow valuation. We can apply the free cash flow valuation method when a public limited company satisfies the following criteria. A. The firm has positive free cash flow. B. The firm does not pay dividend. C. Even if the firm pays dividend, the relationship between earnings and dividend is neither positive nor aligned. In other words, the firm should increase the dividend when earnings go up or decrease the dividend when earnings go down. Just a caution, if you ever apply the free cash flow valuation model and the target price comes out to be negative, the firm for which you are estimating value may likely have negative free cash flow. Let's assume for now that the company you are about to value meets all the criteria of the free cash flow valuation model I have just mentioned. There are three types of free cash flow valuation depending on the three different stages of growth. A company's growth is stable, so you can use this simple valuation formula to get firm value. All you need to know is the free cash flow or FCFF of next year, the constant growth rate of FCFF that will hold for infinite years into the future, and the company's weighted average cost of capital or Wacc. A company has high growth in its free cash flow, and then after a certain period it stabilizes and grows at a constant rate into the infinite future. In this case, a two-stage growth model is used. You can use this simple valuation formula where growth stabilizes. Lastly, a company can also have three stages of growth in its FCF: high growth, transition, and stable growth. In this case, a three-stage growth model is used. However, this is beyond the scope of our discussion today. We will be using only a two-stage model for today's exercise, and the Excel template I will use is custom designed for the two-stage model. I hope you have the template file right now. If you don't, please check the video description and I will leave a link to the template. As you can see in the Excel template, there are a lot of NAs. You are going to enter information into the yellow highlighted cells only. If you scroll down, you will see a lot of yellow highlighted cells. I suggest you do not change any other cell information, or else the template file may break. If you accidentally break the file while working, you can download a fresh copy and work right from the beginning. The template file has 4 sheets. The first is FCF valuation, in which you enter information and edit assumptions. The second one is historical annual file, where you will paste the firm's income statement, balance sheet, and cash flow statement information. This information will come from morningstar.com. You will paste analysts' estimates from Yahoo Finance into the third sheet. In the final sheet, you will paste the company name and beta coefficient information from Yahoo Finance. To summarize, we will mainly collect information from the morningstar.com and Yahoo Finance websites. All this information is for free. For today's free cash flow valuation exercise, I will use CVS Health Corporation. Click on the S&P 500 sheet in your template. Let's go to Yahoo Finance. Type in the ticker symbol CVS. From the Summary tab, copy the name of the company by pressing Ctrl+C in your keyboard and paste it into cell B2. Type the ticker symbol as CVS. The beta coefficient is listed as 0.53 as of today. I will type in this number in cell C2. The adjusted beta coefficient in cell D2 is automatically calculated. This is called Bloom adjusted beta. If you are interested in it, you can look that up. Let's go to the estimates sheet. Information on this sheet will come from Yahoo Finance as well. click on the Analysis tab. We only need an estimate of earnings and revenues from here. Copy this and paste it into cell A1 by pressing Ctrl V on your keyboard. Let's pay attention to the yellow highlight. Cells I9 to L9 refer to the average estimate in cells B9 to E9. Notice that the numbers in cell B10 and E10 are in billions with the letter B in it. To convert this number to a whole number, I wrote a formula in cell J7. All you need to do is check if everything is correct or not. Looks like everything is fine. Now, click the Historical Finance tab. This is where you will paste CVS's financial statement information from Morningstar.com. You can copy the link given or manually type in Morningstar.com in a new browser. If you are doing a different company, you can change the ticker symbol in the address bar and press Enter to go to that company's information page. Click Income Statement tab and expand the view. Click Export Data. Open the downloaded Excel file. Notice one thing here. Your template file has all the account names left aligned. But in the downloaded file, all the names have many spaces at the beginning. We need to get rid of these spaces and make everything left aligned. Let's make this adjustment. Right-click on the column head and insert a new column to the left. In cell A2, write a formula as equal trim parenthesis B2 parenthesis close and press Enter. Now copy the formula down till the end of the row. After expanding the column, all text in the cells is left aligned. To copy from cells A2 to A68, click cell A2, hold down Shift and Control and press down arrow on your keyboard. Press Ctrl C. Click on cell B2, then from the paste menu, paste only the values. Delete column A. Now select cells A1 to cell G68 and press Ctrl C. Go to the Historical Annual Finance tab and press Ctrl V. Close the downloaded file. Go to Morningstar again, click Balance Sheet tab and expand the view. Click Export Data. Open the downloaded Excel file. Let's clean the data. Right-click on column head and insert a new column to the left. In cell A2, write a formula as equals trim B2 in the parentheses and press Enter. Now copy the formula down till the end of the row. You can see that all text in the cells is left aligned. To copy from cells A2 to A68, click cell A2, hold down Shift and Control and press down arrow on your keyboard. Press Ctrl C, click on cell B2, then from the paste menu, paste only the values. Delete column A. Now select cells A1 to cell F139 and press Ctrl C. Go to the Historical Annual Fin tab, leave one row blank and press Ctrl V. Close the downloaded file. Go to the Morningstar again one last time. Click Cash Flow tab and expand the view. Click Export Data. Open the downloaded Excel file. Let's adjust the data. Right-click on column head and insert a new column to the left. In cell A2, write a formula as equals trim B2 in the parentheses and press Enter. Now copy the formula down till the end of the row, press Ctrl C, click on cell B2, then from the paste menu, paste only the values. Delete column A. Now select cells A1 to cell G67 and press Ctrl C. Go to the Historical Annual Fin tab, leave one row blank and press Ctrl V. Close the downloaded file. Now go to the FCF valuation tab. The first thing I like to do is type in the ticker symbol as CVS. Cell C1 should be automatically populated. In cell B2, I will type in today's date because this is the day I am doing this valuation. You should always type in a date when you are doing the valuation. Please note that valuation is date sensitive because the target price estimate is only valid today. As time passes, this valuation may be invalid. Let's go straight to the end. Inspect each and every row to see if they are populated or not. In my case, all the numbers are correctly populated. If you do another company, your numbers may not be populated correctly. Just to give you an example, let's change the text in cell A64 to cash and cash equivalents 3. Now, go to the FCF valuation sheet and see it is showing NAs. The reason is that Excel uses VLOOKUP function to find information in the destination sheet. VLOOKUP function says find A71, which is cash and cash equivalents, in a range of cells from A51 to F250 in Historical Annual Financial Sheet. The name has to be an exact match. In my example, the cell range leaves row 251 to row 266 out. But you can always revise the VLOOKUP to include them. Just change the range from A51 to F266. Since I intentionally changed the text in cell A64, Excel fails to find the match and shows NAs. You can fix this issue by manually looking for cash and cash equivalents in the balance sheet. Sometimes the name could be a little different, such as cash at hand. In our case, in cell A64, the name is similar except for the number 3 at the end. To fix this issue, you can change it here or change the name in the template. I recommend changing it here. Do not change the name in the FCF valuation sheet. I will copy the name from the first sheet and paste it into the cell A64 of the Historical Finance tab. Now, go back to the first sheet to see that cells have been repopulated. So, this is how you address the issue of cells showing a lot of NAs. Let's move on to the historical median section. Always remember to be conservative in your estimation when predicting the future. Cells N37 to N43 show the historical median information. We will use this median information to fill out cells from L37 to L42. For example, the median of 9.55% in cell N37 is the historical median of growth rate in revenues from 2019 to 2023. Let's change the numbers in the yellow cells. In cell L37, I will assume that the growth rate in revenues in the year 2029 will be similar to the historical median. Hence, I type 9 in cell L37 by rounding up the median values of 9.55%. Similarly, I type in 6 in cell L38, 1.5 in cell L39, 18.5 as effective tax rate in cell L40, 17 in cell L41, -1 in cell L42. Let's scroll up. 10-year Treasury yield is the risk-free rate. This number is used to calculate the weighted average cost of capital. I will copy the link that is given and paste it into a new browser tab. Select the year 2024 as we are in 2024 now and hit apply. The risk-free rate is listed in this column. Scroll down until you see today's date or the last row. The last available date is given as September 20th. I will copy 3.73 and type this number in my template file in cell G22. For implied equity risk premium, copy the link and paste it into a new web browser. Among the three lines, we'll be looking at the black line, which is the implied market risk premium. Hover your mouse to the last point of the line. The IMPR is 2.51%. This data is last updated in July. Go to the template file and type 2.51 into cell G24. The pre-tax cost of debt is a little hard to find. Sometimes you don't find this information on the finra.org website. You can search in Google with keywords such as list of bonds issued by CBS Health Corporation. I'm going to use a new browser tab and do a Google search. If you do another company, you can adjust the search terms accordingly. This information you see coming from this website. I'm going to open this site. Now, I see many bonds with different maturity issued by CVS. I will select the bond that will expire in approximately 10 years. The reason is that my risk-free rate was based on 10-year treasury bond. In this way, I make both bonds similar in maturity. I will look at the bond which will expire in 2033. The cost of debt for CVS is the yield of this bond, which is 4.9652%. Please remember that the coupon rate is not the cost of debt. Go back to the template file and type 4.9652 into cell G27. Sometimes the company does not have bond information available because they have never issued a bond, or you cannot find this information anywhere. In this case, you can check alternative sources such as FactSet, which is not free. You need to have a subscription. Luckily, I have a subscription to FactSet. So let me show it to you. Log into FactSet. In the search box, type in CVS. To get the information on bonds issued by CVS, click Credit Analysis from the left panel and then click DCS Detail. Now, you see all the bonds issued by CVS. Scroll down until you see Notes and Bonds. You will look for a bond that will expire in 10 years. Here's the one that will expire in the year 2034. I will collect the yield, not the coupon. The yield of this bond is 5.07%, which can be used as the cost of debt of CVS. Let's assume that CVS Health never issued a bond. Then we do not have the cost of debt for CVS. What we can do is find matched firms that are similar to CVS in the sense that they might be operating in the same industry or they're similar in size in terms of market cap. Usually, the competitors of CVS can be matched firms. If any of the matching firms have bond information available, you can use that information to calculate CVS's debt cost. Here is how you can find the competitors. On the left panel, click Company Analysis. Now, you can see the competitor firms, one of which can be a matched firm. I can see United Health, Cigna, Oscar, and many others. Based on the market cap, the matching firm of CVS could be Cigna. Based on stock price, the matching firm of CVS could be Centene. If you want, you can relax your matching criteria to get more matching firms. Once you identify the matching firm, look for the bond yield information of that matched firm and use this as the cost of debt of CVS. This is how you can solve the issue of missing cost of debt information. Now, going back to our Excel template, the tax rate comes from row number 40, where you assume that the effective tax rate in the year 2029 is about 18.5% and will be the same from 2024 to 2028. Type 18.5 as the tax rate in cell G28. The weight of debt is coming from row number 43. The historical median is about 56.33. I'm going to take this number and round it up to 56%. Type 56 in cell G29. Notice that the Wacc for CVS is about 4.67% based on the numbers we have just entered. Because our model is a two-stage growth model, we need to assume the constant growth rate of free cash flow after the year 2029. We like to assume that free cash flow will grow by a constant of 0.5% from 2029 to infinity. If you put a larger growth rate here, your FCF will explode in maybe 100 years from today. Therefore, it's a good practice to be conservative in your estimate and assume a smaller number here. I think 0.5% is a reasonable estimate here. Based on Yahoo Finance, today's stock price is about $57.51. I will type this number in both cell B28 and C28. Now that we have covered all the yellow highlighted cells, it is time to look at the target stock price and make a decision. In row 27, you have two price targets in cells B27 and C27 of $183.59 and $246.86. While one uses constant G as an assumption, the other uses ROIC equals WACC. These target prices of CVS are also called intrinsic value or fundamental value. Since both of the target prices are greater than the current market price of $57.51, CVS Health Corporation is currently undervalued in the market. In other words, the price of CVS will increase to our target price in the near future, given that our model and assumptions are correct. Therefore, we can offer a buy recommendation for this undervalued stock that may eventually lead to a potential return of 219% to 329% in a year or more. I hope that using this template file and the FCF valuation method shown in this video, you can estimate the target price of any public limited company and conclude whether the stock is over or undervalued. In the next video, I will show the residual income model valuation to estimate the target price of a company. Stay tuned. Thanks for watching this video.